Okay. Hello, hello. Let's adjust this. Hopefully this is all right. While we're waiting, if you want to give me some topics of interest, I can work on covering them. I don't have that big of a set agenda today, just a few observations and ideas is where I think the market may go. So there's a little chat box in the corner. No one has anything to say? Very quiet today. Ah, there we go. Hello. I was asked about that Lam Research yesterday, and I said it was a short. And the financials, yes, we can talk about those. Tech wreck. Talk about tech. I don't know if I would say it's a wreck, but we'll talk a little bit about the mechanics of the stock market and what lock-in is. Priceline, huh? How is Priceline? I haven't taken a look at that in the last couple days. Probably up a lot today, though, now. Let's see. Yeah. XLU. Could talk about that. Some utilities and the bonds. Micron, possibly. We can get to that one. Everyone loves that Micron, right? I'm so underwhelmed by them, but it is what it is. That's it? All right, so let's begin. So first and foremost, if you're not following me on Twitter, my handle is @JustinPulitzer. I don't know how much longer they're going to keep me on there, though. If you noticed today, there was a little bit of controversy. I had a little bit of some comments, and they had blocked my account for a little while. I've created a backup account just in case this tyranny were ever to occur again, and I highly advise following me on that account as well. That's Justin P Trades, JUSTIN, the letter P, TRADES. If you're not following me on there, put it on there. You never know. I'll keep that up as a backup. Anyhow, let's get into it here. Yeah, it was really ridiculous. I mean, honestly, the tweet that got me, they didn't fully block me, but they originally locked me out, and they put me into like a bit of a timeout where only people who follow me can see my tweets. And all I wrote was, you just called the President of the United States a complete moron. You should have respect for the office, sir. You're a disgrace. And they blocked me for that. It's completely ridiculous. I think the guy who I had sent that to must have been like one of the founders or whatever, because his first name, @Jason or whatever, is the, usually when you have first names, they tend to be like founders in Twitter. And I guess that I was persona non grata for that tweet. Anyway, it is what it is. And I guess, that's part of the reason why Twitter has been having problems. They're shutting down free speech that they don't agree with, although in another note, they got themselves a new diversity director. I saw they just hired a new VP diversity director. Amazing job they're doing over there. That should really help shareholders who are down 75% or whatever it is in their shares from the peak. So, still struggling to find their voice over there at Twitter, apparently. As far as the stock goes, it's just one you either own or you don't. I mean, it's got a lot of back and forth. I've said for a while they need to prove themselves like Facebook did with 2 back-to-back quarters. And that's it. That's just how it is. Anyway, let's get into the markets. I'm going to discuss a little bit about what's going on in the market. Let's start out as usual with the market keys. We'll get into the major market indices, and I'll try and discuss some of the big stocks. This is a big week. It's the end of the first half and the end of the second quarter, and right before summer break. Right, a lot of people take extended vacations and so on and so forth, and we haven't seen a lot of volatility. I mean, the VIX is basically just, pinned to the mat here. Just looking at some of the CCAR results, I see Capital One is getting served up after hours, not doing so well. Let's see that. I want to just see where JPM is. They're doing well, of course. Anyway, VIX is just kind of hanging out. I would expect if we may see some people buying some protection again after the quarter ends. I really think that we're going to know the direction of the market for the balance of the summer sometime either next week or the week after, because next week you still have a lot of people who are on vacation or whatever, but it's the start of the Q, and there may be some, positioning for Q3, but the week after, maybe even next week, we'll see. I think that is going to determine our direction, whether we're going to keep listing sideways to down, or if we're going to get a breakout or, a breakdown. I had posted a picture of a chart of the S&P that, if you have a moment, take a look at that, because when we cover it, it'll be very helpful. The dollar is making new lows. I've discussed this, that I thought we were going to see the reference low of 35.88.5. That was sort of almost like a flash crash low. The good news for the dollar, if you're a dollar bull, I don't know that many people that are, is we're getting close to the channel low, which is my target. So I do think that we may get a little bit of stability in the dollar for some bouncy type action here. I've been looking in the UUP for a 24.47 test where I'd be looking to buy long. That's sort of my spot for a bounce. I'm just noticing Citigroup, Morgan Stanley, and Wells Fargo are doing okay after the CCAR, the stress tests. By the way, those stress tests are so ridiculous. Some of the metrics they used in them are just silly, but anyway, those are doing well also, so I'm kind of monitoring that as we're talking. So I am looking for maybe a little bit more down in the dollar, but looking for that to have a bounce soon. The bonds have been having a bit of a pullback. Oddly enough, they didn't quite get the full 130 gap fill, and they do have a evening star reversal pattern, an island reversal from 626. Take a look at that. You had a topping tail doji and then a gap down, now followed through lower. So we could maybe have a top in the bonds for a little while here. It held and bounced off the 20 MA today, and I'll say this, it's been very choppy with the bonds. It's been like this sort of stair step up. Like you have this move up, down, up, down. It's just been very choppy. So this area right here, the 20 MA is key. I'd say if you lose the 20 MA, we could have a retest of that 250 MA confluence lower and fill in that gap down there. So I'm keeping an eye on that. I think that's also contributed partially to some of the reason for the pullback we've had in tech. I'm noticing Capital One firming a bit. They think they have they announced some buyback information, so that could be firming that up. So 20 MA to me is really key here. I think you could use today's range as a gauge, either long above for a bounce up or short below for that move lower. XLU, someone asked about the utilities. That's having a bit of a pullback also. I had drawn in a channel that I showed in my weekend video that we touched the channel high, and I said just as everyone's going to love these things, they're going to not love them for much longer. We now have a rally to a lower high on this leg, and we took out that swing, and now we have a new low. So I'd say we've topped in the utilities for a while. We broke the 50 MA today. We broke the trend today. and we're basically coming back down to the breakout area, which is close to the 100 MA. I've been very clear on my views about how we trade the moving averages lately. When you lose 10s, you see 20s. When you lose 20s, you see 50s. When you lose 50s, you see 100s. And when you lose 100s, you see 200s. I'll say that again. When you lose 10s, you make 20s. When you lose 20s, you see 50s. When you lose 50s, you see 100s. When you lose 100s, you see 200s. We've now lost to 50 MA. So if we're below that, we should see the 100 MA. The news, though, is that the 100 MA is like, it's like a little bit of a joke. It's right here. The 100 MA is at 51.83, where I do think we'll have some stability for a bit of a bounce before maybe ultimately going a little bit lower. To see a range low, which is potentially down near where the 50% fib or the 200 MA is, down near, let's say, $50. Into that region, I mean, my max downside potential for this here is like 48.88. That's the 61.8, and was a huge consolidation range for a breakout. Yes, it's decent amount point-wise here, but I don't really think that this is going to like completely fall apart. I mean, the bigger trend line, and I'm just looking lower, is, I mean, the real channel low is like in the 30s, like 32. I just don't see that happening so fast. Maybe eventually, but I do think that for some trades we can play into the fibs, which is 49.88 is the halfback, and then the 61.8 is 48.88. If we were to come that low, I'd be looking to sell out of the money puts, or maybe even scoop some shares for a bounce. Like I said, though, I think this 100 MA, though, is going to stabilize things for a little bit, and we'll see how that plays out in the 51s, just below 52. HIG, that's the high yield. Now, this is where everyone, I'll tell you, charts, same as you just use, which is the most important moving average to me? The answer to that is it's different for every stock. You'll often notice some respond to different moving averages differently. I've got to shut this off quickly. I just ran the I have a little thing running. I'm going to shut it off quick. Just stay. At that, I was running something and it went off. Highly professional, you can see. Anyway, everyone gets crazy when HYG has a little bit of a pullback, and the case this time was because oil had softened. It's since rallied and has a higher low and now kind of stair-stepping up. I don't get too crazy about this thing until it loses like the 200 MA, and it held basically the 100 MA. It's now back up above the 50 and now back up above the 10 and the 20, and kind of challenging that 88.37 level. 88.37 was a interim swing high before a very large pullback, so it's kind of key. The more time it's above there, the better. The less time is worse. I honestly think we're just going to kind of chop sideways in the credit here. I don't see any type of a credit event. Oil would really have to get ugly. I think a lot of the weakness in oil was we saw, I don't know, a year or so ago, when we had, even 2 years ago, when we had that big drop in the HYG, because these firms hadn't hedged their oil positions, and I think a lot of them have sold forwards and futures to hedge positions, and I don't think that there's that type of credit exposure that to the same degree that there was before. So that's my take on the high yield. As far as oil goes, the aforementioned oil, remember in the weekend review video I said that there's probably going to be some stabilization and a bounce in oil because we've been trading in this very narrow channel lower, and we were at the channel low, and I thought we'd at least trade sideways to higher. We actually broke out of that channel yesterday, and today even stronger. And I had said that I didn't know if we were going to be in the $10 to $12 correction mode, which I said I was suspicious that we could be in, or if we were going to get the $24 to $25 mode. And I said we'd know very quickly. It looks like we may have only had the $10 and $12 type of correction, and now we're throwing back higher. My first target here is close, the 20 MA. That was really what was acting as support, so we're going to have to see where that plays. That's 44.81 at the moment. If we're able to clear that, then the 50 MA is 47.38. I think that so many people got short and were playing short in this, and the sentiment is so bad in this. I mean, it could have some type of a rally. It's now had a few up days though, which is good, and I think that that's provided a little bit of relief. Last night we had some junky numbers, but the oil didn't react too badly. Today, the oil number came out, the EIA number, and there was actually not so much of a draw in oil, but gasoline had the kind of the draw that was being expected, and that was seen as bullish because the whole theory and the fear behind oil is that it's not just a supply issue, that it's a demand issue, and that the economy is slowing. And if gasoline is being consumed, that's what people drive cars with, summer driving season. That's what they use to go to stores, to go out, so on and so forth. As long as that demand is still okay, the economy should be all right, and that's why the market, I think, took those numbers in stride today. So we've bounced a good amount in oil. There may be a little bit of back off, but it did now break the down channel, and it seems to me like it could be in an upswing rally. If we were to take a Fibonacci retracement from the peak of this last leg, which was 52, to the trough down at 42.05, excuse me, the 38.2% fib is 45.85. And the halfback is 47.03, which would roughly coincide with that 50-day moving average. So I like that. 48.20 is the 61.8, which is where all the congestion. And the big gap fill is at 61, so that was into support as well and bouncing a bit. Exxon has still yet to kind of make new lows. It's just been hanging out. Now it's right below the 50 MA. So you have 3 days of equal highs. So I would say if you could punch through that, you might fly back up to the higher end of range. Keep in mind, if that were to happen, we're now coming off of a higher low. You sort of had that look below and fail excess low, rally up to range high, now pulling back to range low, the traditional range low. And if we were to come back up again, you'd have been coming up off of a higher low, which I think would be very noteworthy. So watch like the 3 day, let's just say the 2 day range. I like long above, short below. That's the Exxon. China, how is China going? China is kind of, like I said, we would hit that area, back off a bit. It's been holding in fine. This to me doesn't look like any type of crisis mode. Holding just fine. IBB, the biotechs, we shot up. I said I thought we'd see some back off that gap fill. Remember I mentioned that 315.55 to 321.12 area. We're now backed off. We're into the channel, and today's rally stalled at the channel high. So I think you could use today's range as a gauge, either long above or short below. Let's keep it simple with the IBB. I had mentioned Gilead. Often I watch price action. Gilead is into my targets here. My end target is 673, like 13 to 74s. That's sort of like the gap fill and the down channel. I think you could book some here. If you want, you could just use low of day as a stop, because that would be just below the 200 MA. I liked booking some at the 200 MA, and then just keep raising stops. That's an important level for me. We did IBV. The transports, was one that started turning, and I mentioned this. This was also one of the reasons why I wasn't that bearish. I had said we had negated the right shoulder, and we kind of had check back and now back up to a higher high. This quote unquote should see the recent high and maybe even higher. The channel would be up at like 77.5 if it were to get back to the channel high. So this is looking okay, much improved. Even FedEx today had some bad news, and the stock handled it. It met bad news with a new all-time high. They said that they had some cyber hacking and it might be material. The stock was halted and then made a new high. So that the stock should have been smashed on that, and it made a new high. So that just shows you the path of least resistance seems a little bit higher short term here. Copper, Dr. Copper, I've said also is not anywhere near signaling a recession. You had that move up, a bull flag, and now it's breaking out of the flag back to the upside. So above the 100 MA is good. Copper to me looks good. I mean, this seems like maybe the reflation trade might get some new legs again. XLF also negating the head and shoulders pattern now pretty convincingly. I had said I thought that it was still okay. Remember, I said in the weekend review that I thought it was pulling back a little bit to see maybe 150 MA retest, and I said as long as it held that 50, it was okay, a right or right out buy. Back up to the upside, fully negating the head and shoulders pattern now. I'll tell you, a head and shoulders pattern is obviously very bearish. When a head and shoulders pattern is negated, that can take off. And I'll tell you, if the financial stocks now really do start taking off again, and I'm looking at JPM, which I had mentioned in the weekend video that I thought was pretty good, this could give another, that could be the onus for the rally to continue in the market. Maybe very convincingly so. And if interest rates, like I had said, really have now bottomed, meaning bonds have peaked, this could really start getting going. Now, I want to caution people, when you hear the media talk about the reason for the rally in the financials, it isn't because of interest rates, really. That's like kind of the cream on the top of the cake. But the whole cake, the reason why you had this big move in the financials is because of the prospect of deregulation. These companies were so badly hurt by the financial regulations of, like, Dodd-Frank and so on and so forth, Sarbox. These can now be businesses again. They were basically utilities in purgatory, and now they can be profit centers again, and that's why the banks are really rallying. And that's all Trump, by the way. This would not be the case, in my view, if you would have had a Hillary win. I think that Elizabeth Warren would be in charge of the banking committee, and these stocks would probably be, we'd be talking about the breakup of the banks. All right, so we covered that. JPM, I think, by the way, at some point is a $100 stock. It's just a matter of how it gets there. Short puts is a long proxy here. We have now taken out those tweezers. We've now taken out the range high. The tweezers I had mentioned were at 89.13. The range high was 89.46. This is now fully negating also the right shoulder. And I had said I was a little leery a couple of weeks ago of the Finns, considering that JPM, their leader, wasn't leading. It is now leading again, so it's all good in the hood. Sort of like when NASDAQ is rallying without Apple. It's just not the same. So now you have the JPM rally. Now, I will caution this. There might be a little sell the news to come in these because they have rallied a hell of a lot. But the dips now are buyable. Absolutely buyable, in my view, in the banks, particularly if the 50 MA holds, which is now, by the way, you're about to have the 20 recross above the 50, good sign. And the 50 is now upward sloping again. That is also a good sign. All good so far on these accounts. So I'd expect to see this re-challenge the all-time high, which is what, 93, 98 at some point. If it's a straight shot, any break above there, everyone's going to be excited to buy that breakout. It will be one to fade initially, though, if there's no breather, because we've now come up from the bottom. When you come up from the bottom, breakouts are harder to sustain. Just keep that in mind. It's how you get there is what's important. Someone asked, what are you? I'm Batman. You can have a little fun with it, right? SPY. All right, let's just get to it right here. The serious business. SPY is in a down channel, but it's a very, very narrow channel. This is more almost like a bull flag. Yesterday, we did take out the big diamond pattern low, but we knew this was happening. I had said on this day on 6/19 that was a look above and fail basically, because wait, let me look in SPX because SPY had that dividend. I'm like, what am I looking at here? This wasn't a look above and fail, but it was. Yeah, 6/19. If you go to SPX, there was a look above range that failed back down. We got into the lower end of the triangle, and I said it that day that we should quote unquote now rotate to the lower end of the range. We got that yesterday. We had one day that kind of like was a bit of a throw off on 6/26, but it closed bearish. The next day was down. I had said I thought that the move, we could have still seen a little bit lower to the 50 MA, but I wasn't expecting a ton more down. Now today we were back up and took back the entirety of yesterday's move. That just shows you how much strength the bears have here. They're sort of like paper tigers. Let's go into the internals for a minute. I pointed this out yesterday, and I had said I thought we would see a little bit more lock-in today, but after that I thought the pressure would alleviate, and I was amazed it like alleviated almost immediately today. It was even sooner than I had expected. Yesterday, at the worst of it, the AD line, the advanced decline line, was down 900. Today was up 1900. The breadth today was almost 4-to-1 on the NYSE, and by the end of the day, the NASDAQ was almost 4-to-1. That is not a bear market. And it shows you that the viciousness of yesterday's decline, the down ratios were like 2-to-1. I think at the worst, I don't think the NASDAQ was even that bad. And you had a huge bloodletting in those stocks. And I had said it was amazing that the internals were still as strong as they were. And then today, even in the weakness, and this is when I had said that I was seeing the, if you go back on the stream before the nastiness that happened with the blockage and all that bullshit, frankly, you'll see that the ticks, I had mentioned in the NASDAQ ticks, were hanging out above the zero line. So the declines, the lock-in was abating, it was ending. It wasn't picking up more steam again. And listen, I might not have been quick enough to point out, that we were down, that this was abating in Amazon when it was down 5, but when it was only up 2, that's when we started talking about it, and then today it was up 13. So this, I'm not always the guy who catches the dead low, but I try to catch the meat of the move on these instruments. So what is going on? Why were these stocks down so much? All right, there's two ways you can look at end of quarter. There's a lot of games that go on, and if stocks are up big already into the end of the quarter, there's something known as lock-in, meaning the funds sell them to lock in the gains. If stocks are down, then there's markup. They run up the prices so that they can show their investors they were, did great, and they had this last week of like unabated upness usually. So we had a bit of lock-in. Now we're getting a little bit of markup. I would say this: as long as we're above yesterday's high, and I'm willing to, let's say there's a little weakness early in the morning tomorrow, as long as we hold that 10 and 20 MA confluence now, we should see the high end of range, and we should potentially even see a new high. If we start losing that, and we start losing too much of the rally today, like half of the rally, it's no good. It'll be very problematic to my eye. It would say that we should have been stronger. Sometimes when something should happen and it doesn't, it's a problem. So if we're in SPY, back to SPY, if we're gonna see the channel high, it should be around 244s, low to mid 244s. So technically we should be up there soon. Whether it's going to bust out to the upside or whether we're going to come back down, we'll have to view the market internals at that time. But there should be a little bit of so what about the diamond pattern now? All right, so let's go back to SPX. As far as the diamond pattern goes, we've now seen a false break to the upside, and a move back down to range low. And now we're above the diamond again. We're not in the. We're not. I would have to redraw this actually as a new diamond, which I could make the argument that we're in. But now we're trading sort of on the other side of it, the other side of the diamond, and I think we have to go now by levels again. I don't really get bearish in this market until we convincingly lose the 50 MA, and then I would say I think we'd see the 100 MA, but honestly the 100 MA, we've spent so much time up here, the 100 is starting to catch up. So I'm still thinking the market is a bit of a buy the dip situation until we see a market change, like where we can have multiple days down and have follow through. Like yesterday, as nasty as it was, there was no follow through. We're back up above that high today. And today's internals were stronger on an up day than the down day. When you start seeing real OTF money, other time frame money, meaning not algos, not day traders, not the guys with like 1 or 2 or 5 or 10 or 20 contracts, guys that are dealing in hundreds of contracts or thousands of contracts, or thousands or hundreds of thousands of shares, that's when I would say, like, let's say yesterday was down 8-1 or whatever internals. It wasn't. It was very mild. But let's just say, for argument's sake, we're down 8-1, and then today we had like this middle measly rally that took back like a third, and then like it closed near the low or in the middle of the doji on like 2-1 breath. That to me would say that there's a problem. You now have more sellers on down days than you have buyers on up days. Today, your internals were stronger on an up day than the bad ones were on a down day. That is very key. That is very telling. It's telling me there's no real sellers in the market. Again, it's end of quarter. This could all come to an end next week. We could be down every day of the week next week and start the summer correction. But we won't know until it sort of happens. And how do we know? We go by levels, we go by price action, we go by moving averages, we go by ranges. These are all the keys so that you're not caught up. So you're not on day 5 of a downturn, first puking it up. You'll have seen that turn on day 1 or 2. Anyway, like I said, we should now come up, since we had now a successful test of the lower end of range, we took out the high, we should now, quote unquote, see that higher end of range. The Qs, a little bit more problematic to my eye, even though we had a lot of strength in the big names today. You had Amazon up nicely. We had Apple up nicely. We had basically everything that was slammed yesterday. Facebook was up. Google was down early today and reversed. How do you like that EU shakedown of Google? I mean, this stuff is just ridiculous. I'll tell you, these tech companies should start playing a little bit more nicely with the president, because they're going to need his support if they're going to start trying to pick on these tech companies. These are countries in Europe that have very big budget problems, and they're looking to kind of stick their hands in people's pockets, and they're picking on American companies. They did this to Microsoft, and it looks like now they're trying to do it to Google. What was I just looking at? I wanted to look at Netflix. The Netflix, where is it? I think it was up pretty good today, right? Let's see. Why? It's not on my screen. Oh no, Nvidia was up good, and Netflix, yeah. When tech gets into weakening, yesterday was a story-specific situation with Google, which also fed into bringing the market down. So when you have a story-specific, it's not one I pay attention to as a leader of the move. Nvidia and Netflix and Apple and Amazon and Apple and Google. I mean, not Google. I'm sorry. The ones I was watching was Amazon, Nvidia, and Netflix, because those are the ones that took it on the chin pretty badly yesterday. And when they started turning, today also started making some moves. So here's the story with the Qs. So you had to look below yesterday's range that failed. We stopped just short of my reference low retest, which I was looking for. But the bad news, so there's good news and bad news. One is that we held the range low, it didn't break. You had basically same size body candles with a look below and fail lining up. We basically closed at close to yesterday's high of day. And we're back up above the 50 MA. Good. The problem is now you have 1, 2, 3 retests of the low, and if you were to, let's say you have a retest of the low or a first test of a low that you lose, it usually has a move down. If you have 2 tests and then it moves down, every time you have a successful test of a low, the time that it doesn't hold and it breaks, the probability of a much larger move lower increases, particularly when they're hammers, because that's where everyone has their stops. That's where the algorithms are laying in wait for the short. So keep that in mind. We're still below the 20 MA, which is a little iffy to me, and we haven't yet filled the gap. So and we're coming off of a lower high now on a separate leg. This is all just still consolidation, and the more we're kind of bear flagging out here, the worse an eventual break could be. So just keep that in mind. I've been thinking this week there was high OI in 135s, 132.56 is like the gap fill. So that's sort of like my downside potential. If there was a snap of 137s, I think we'd see 135s maybe in 132s. So that's what I'm looking at. I think you could use now the 2-day range, particularly today's range, long above the high for the move back up, or short below the low for a potential breakdown. Yesterday also I was mentioning IWM was not looking very bearish. I'm sorry, the last couple of sessions it wasn't as bearish. We didn't get a 50 MA test. Yeah, it was down, but it wasn't. It was just below the 20. And then today we were back up, and we're now basically above the 141.82, which was the last reference high. So the longer this is kind of up here, the better. There was a little bit of excess we had mentioned. It was a look above and fail. It came back down, but the pullback now was shallow, and you're basically back up to highs. So IWM is still acting fairly well. Let me get into some of the stocks that you all want to talk about. And then we'll call quits. Let me see what I went through. I went through this one already. I went through this one already. I went through this one. All right, so there's not that much left to go, and then we could end at a relatively decent time. Lam Research. So yesterday I had said this looked like a bit of a short in my view once you broke the 50 and the reference low. Today you stopped basically on the last reference low. So I think you could use the 2-day range as your gauge. If you're above today and yesterday's high of day, this could continue up a little bit more. I'm drawing in a downtrend from the 613 high. That's the lower high. I often find that drawing trends from the lower highs are the ones to follow. And now we've been making now lower highs and lower lows. So you need to see that pattern shift, right? I think the risk there is maybe the 100 MA, potentially the gap fill down to 127, so like 136.64 to 127.34. That's I don't really use 38.2s, but it's also a gap fill. I think that area to me would be an area maybe to play for a bounce. This seems to be kind of bouncing around, but I think you could again use today's range as a gauge, long above or short below. Celgene, not one I look at all that often, but this thing is up here. It moved up a lot. It's consolidating now more by time than by price. And the breakout was above the 50 MA. We're a long way from the 50, but I would say pullbacks to the 50 are buyable. I think you could, again, today's range was a big range, and it really encompasses this consolidation flag. So I think you could play, again, long above or short below. The 10-day is catching up quickly. If you were to lose like the 10-day, there could be like some kind of a slide back to like 127s, but this looks okay to me. It looks fairly bullish. The more I do want it to spend a little bit more time consolidating though, because it did rush up so fast. Target didn't quite get my 61.8, which was 48.23, and now it's consolidating here. How many gap downs has this had? Holy cow. 1, 2, 3 gap downs. The 50 MA was really key support for this. It needs to really get back up over the 50, in my view. If you want to play right or right out with this thing, I mean, I guess you could play with a $50 stop at this point. But I think this is just going to bounce around in this range really for a while. I think that if it happened to fill the gap before the earnings, you might have an opportunity for a short. Like if this rallies up into the earnings, it probably would be a bit of a short. I think this thing is just going to chop and mark time. I have retailers that I think I like much better than this, like Walmart, for example. I was hoping that it's been rallying, but I was hoping that it was going to come down a little bit more. This could get whacked again, oddly enough, but on that dip is where I would want to be buying. I'd like to be buying Walmart like in the 68s, maybe 71s in that area. I'd probably be selling out of the money puts if there's further weakness in Walmart. Kroger is filling the gap. I actually had sold some puts in this thing, and it's starting to fill one of the gaps, which I think it will complete. And then after that, I may peel it off depending on where the put is at the time. I don't think I have a lot now. I don't have a very big position in that at all. Just a couple, small, very small. Priceline, let's talk about it, right? This is in a consolidation pattern. A lot of people were looking to get bearish on this, and I had said we were still holding the range, but the 50 MA, I said a break was a short. We got that move down, but now it's kind of back up. I think you could use the 20 MA here as the gauge, which is basically today's low. Today had a bit of a look above the downtrend that failed, but I'll say this. It closed strong, and the last touch, the last swing high, which was like 2 days ago, the 26th, was a perfect touch, a pullback, and now we're right back to it. This to me looks like it's kind of just consolidating under that trend, and looks like it may, if the market stays firm, could go further. This could see the 199 level. This to me looks like a bull flag. A large one, mind you, but it to me looks like a bit of a bull flag. You're now at the higher end of that flag, so I'd like to see a little bit more consolidation under there and then go. So I think you could use, if you lost today's low, I think you'd have a nice short down to the range low, probably close to the 50 MA. If you were to clear these recent highs, it could probably continue. My concern with that is the SOX and the NASDAQ are not brilliant patterns. The SOX basically held the channel low. It just stopped shy of it today. And you're basically right on that 50 MA. So I think what you could do is watch the SOX, and if that starts performing and holding better, particularly if there were a break over 111.02, let's just say 111.02 in the SOX, I think that all of these stocks would just fly, because that's the low. You have double top lower highs there, and that's where all the stops have to sit. That's basically the bear flag consolidation, and I think you'd fly a lot more into this candle higher, maybe even up to like the 130s, the 1130s, probably the 1120s or 1130s if that were to clear. So keep that in mind. And if you start losing like low of day in this to me would be, all of these stocks would have problems. NVIDIA just hanging out again, a lower high now, equal lows today and yesterday are equal ranges, long above, short below. I do think at some point this is going to have a check back to like the 133s, maybe even like 123s and 121s, which was where the breakout was. So I'm kind of just hanging out with this. I want to see where this is before the next earnings. If this were to pull back into that range, I think you'd have shaken out a lot of that, enough of that hot money that everyone would just think there's going to be a total gap fill, and then it would have another move up. So I kind of want to do a Costanza with this, hoping actually that it has some kind of a summer pullback, and then maybe it sets up for the earnings again. Anyway, thanks for sticking with me here. If you're not following me on Twitter, my handle is @JustinPulitzer. Be sure to follow me on the backup handle now too. That's Justin P. Trades. You never know when tyranny is going to strike again. Have a great rest of your week. I'll see you in the weekend review video. Cheers.